If your savings account is paying almost nothing, your money may be sitting still while prices keep moving up. In this video, you'll see how to stop that leak and put idle cash to work. Even after rates moved up, the FDIC national average savings rate was just 0.42% in December 2024 and 0.38% in July 2025. That's still nowhere near a 4.5% APY. Now make that personal. At Chase's 0.01% APY, $10,000 earns about $1 a year. At 4.21% APY, that same money earns about $421. And if your balance is $25,000, the gap grows to about $1,050 a year. That's real money for doing nothing but choosing a better place to park your cash. A high-yield savings account is still a savings account, not an investment account, so your cash stays available for things you may need soon. The reason many online banks and fintechs pay more is simple. They don't carry the cost of large branch networks, so more of that margin can go back to you as yield. And the best option isn't just a high APY. You also want low friction, like no monthly fee and no minimum balance. Your money isn't losing that protection. At an FDIC-insured bank, coverage is automatic up to $250,000 per depositor, per bank, per ownership category. That protection covers the bank products people use for cash, including savings accounts, money market deposit accounts, and CDs. And yes, that includes online-only banks too, as long as the bank itself is FDIC insured. Digital doesn't mean less protected. Online banks spend less on branches, tellers, and all the physical overhead that comes with running thousands of locations. Because their costs are lower, they can send more of that money back to you in the form of a higher APY. So the real trade-off usually isn't safety. It's that you're using a different kind of banking model, built more around apps and transfers than branch visits. Before you open anything, confirm the bank is FDIC insured and take 1 minute to read the fee schedule. A strong rate doesn't help much if hidden charges quietly eat into it. You're usually looking for the cleanest setup possible, 0 monthly maintenance fees and no minimum opening deposit. That way, the account starts working for you right away, instead of asking you to jump through hoops. Also check whether the rate is variable, because that tells you it can move as market conditions change. The APY you see today isn't always permanent, so it's smart to know that going in. Marcus by Goldman Sachs lists a 3.40% APY, and it keeps the barrier low with no minimum deposit and no monthly fee. Ally comes in at 3.0000% APY, and it adds budgeting-style tools like savings buckets and surprise savings to help you organize the cash you're setting aside. Now compare that with legacy savings rates. Chase pays 0.01%, and US Bank's standard tier is 0.05% unless you meet relationship requirements. At this point, the real question isn't whether to keep cash in savings, it's where that savings should live so it stays safe and earns more. A few minutes of setup now can lift the return on your emergency fund for the rest of the year. So don't get stuck debating the idea for another week. The next move is simply choosing the right account and making the switch. Your high-yield savings account is the right home for money with a job in the near future, like your emergency fund, a down payment you'll use within the next year, or other short-term cash you want safe and ready. For a lot of households, a solid target is enough to cover 3 to 6 months of core expenses. That's the buffer that helps a surprise bill or job change stay stressful, not financially damaging. And if this is money you won't need right away, don't let it sit idle in checking. Move it to the high-yield savings account so it stays accessible, but actually earn something while it waits. If this is money you won't need for years, a savings account is the wrong tool. Long-term money usually belongs in the stock market, where it has a real chance to grow over time. Savings is there to protect cash you'll need soon. Investing is what you use when you can give that money time and aim for higher growth. So think of them as partners, not substitutes. Savings handles readiness and investing handles growth. Each one solves a different problem in your financial life. When you're comparing accounts, start with the basics that actually protect and grow your cash. You want FDIC insurance, a competitive APY, and no monthly fee? Then look closely at how that headline rate works. Sometimes the top APY only kicks in if you set up direct deposit, Open a linked checking account or keep a certain balance. Clean terms beat gimmicks. US Bank Smartly Savings advertises 2.000% APY, but only if you pair it with a linked checking account. Without that extra setup, the rate falls to 0.05%. Wells Fargo tells a similar story. Platinum Savings pays 0.05% APY even when it's paired with Premier Checking, so the relationship perk still barely moves the needle. Yes, those rates beat 0.01%, but compared with top high-yield savings accounts, they're still far too low to make your cash work hard. On $5,000, Chase at 0.01% APY earns about 50 cents in a year. Put that same cash in an account paying 4.21%. and you're closer to $210.50. Now scale that up to $50,000, and the difference isn't pocket change anymore. You're looking at roughly $2,100 more per year. That's why balance size changes everything. The more cash you keep parked in a low-rate account, the more money you quietly give up. First, open the new account online and connect your current checking account so money can move in and out smoothly. Once it's linked, move over your emergency fund or any other short-term savings you want safe, accessible, and finally earning a real yield. And keep your old checking account right where it is for rent, bills, and everyday spending. The savings account is there to hold cash, not replace your day-to-day hub. The setup is usually fast. Opening the account and linking your bank often takes minutes, not days. And you're not tearing up your old setup. Your current bank account can stay exactly where it is. What you're really doing is much smaller than a full switch. You're just redirecting idle cash to a better paying home. Keep money you'll need soon in a high-yield savings account where it stays stable, easy to reach, and earns guaranteed interest while it waits. For money you can leave alone for years, index funds or other long-term investments make more sense because they can ride out market swings and grow over time. Put those two together and you get a smarter system. Cash for safety and investing for growth. Keeping your savings at a traditional bank isn't neutral. If the rate is near zero, it's quietly costing you money year after year. And when both accounts are FDIC insured, the safety difference is usually tiny or not there at all. So the real reason to move is simple. You keep the protection, but finally get a return that actually works for you. Take the next step today. Open an FDIC insured high-yield savings account or review the one you already have and move your short-term cash where it can finally earn more. You don't need to rebuild your whole banking life. Just give your idle savings a better home.